In this presentation, we will discuss the question of how do I pay income tax? We're focusing here on sole proprietorships reporting on a Schedule C. This can be confusing if you're moving from being a W-2 employee to being a self-employed individual reporting income on a Schedule C. Because if you're a W-2 employee, the IRS basically has pressured the employer to pay your taxes for you. You file the Form W-4, which you're required to do, and the employer then is required to take withholdings from your payments and pay them to the IRS. When you're then self-employed, there's no one that's doing that, although you still need to pay your payments to the IRS. So how do you get that done? Well, typically you need to make these estimated payments because the IRS wants to get paid throughout the year. That's not easy to do because you're not going to know how much money you're going to earn, especially if it's a new business. And therefore, you're going to make some type of estimate as to how much you think you're going to earn. And the IRS wants to get those payments throughout the year in a similar fashion as they would if you were a W-2 employee. We're focusing here in terms of our income tax equation up top in income line. However, we are remembering that we're talking about a Schedule C business that has income and expenses that would then flow through the first page of the 1040, represented by this income tax formula in the income section. We're focusing here on the first page of the 1040 in the other income. That would be supported by the Schedule 1, which would be then supported by the Schedule C. How do I pay income tax? Federal income tax is a pay-as-you-go tax. You must pay it as you earn or receive income during the year. An employee usually has income tax withheld from his or her pay. If you do not pay your tax through withholding or do not pay enough tax, that way you might have to pay estimated taxes. So in other words, if you only had W-2 wages and you were an employee, then you'd fill out a W-4 and the employer would have to estimate how much tax to take out. Now, because you have a fairly standardized, if you just have one job and it's fairly standardized, you can kind of figure that out. And you could figure out, and usually the tables that will be used to withhold money from each paycheck will take a little bit too much because it's never exact because our tax system is complicated. Using a progressive tax system and having an income system, you can't be exact on the number. So therefore, you're usually going to overpay a little bit. That's how it's set up. And then you'll get a refund at the end of the time period. That's how it usually works. But if you're in a situation where you have multiple jobs or multiple kind of income sources, or you're self-employed, then it's not as straightforward. And so if you're self-employed, you're going to be getting money that's paying to you, but nobody is responsible for making those withholdings. The IRS still wants the payments throughout the year, however. That's what they mean by a pay-as-you-go system. So that means that they want to you can't just file your return at the end of the year and then pay all the taxes you owed for the year, because the IRS recognizes time value of money, and they'll charge you interest and penalties for not paying throughout the year as you would if you were a W-2 employee. So therefore, you have to in some way figure out how much to pay throughout the year and make estimated payments. That'll typically happen quarterly if most of your income is done through self-employment. Now, if you have some of your income that's self-employment and some of your income that's W-2 wages, then you may be able, if you have a significant amount that's W-2 wages, just make your W-2 withholdings really high, right? A lot higher than they would be if that was your only income. And that might be enough to offset the fact that you're going to have other revenue from your Schedule C business as well. So you have to kind of balance those things out in one way or another. Estimated tax payments. You generally have to make estimated tax payments if you expect to owe taxes, including self-employment tax, discussed later, of $1,000 or more when you file your return. So if you're going to have $1,000 or more, you have to pay of taxes that you believe you will owe. They want their money as they go throughout the year. Otherwise, they're going to charge you. They think of it like a loan. They gave you like a loan, so they're going to charge you interest on it, on the loan, because you didn't pay them on time, and they're going to charge penalties on it. So that's why you have to do it. So use Form 1040-ES, estimated tax for individuals, to figure and pay the tax. If you do not have to make estimated tax payments, you can pay any tax due when you file your return. For more information on estimated tax, you can see publication 505. So if you have questions on how to do this and how to make those estimated tax, you can go to the IRS website, publication 505, irs.gov. The estimated tax forms look something like this. So we have estimated tax payments. Usually there would be 4 of them, right? You're going to be paying quarterly. So it's the fourth quarter. It's just basically a payment voucher, just like you would get with the utility bill. You're going to say, all right, here's a payment voucher, and then send in the payment. And so it's a minimal amount of information. Obviously, the main goal is to get your payments in there, and by doing so, your hope is that you will avoid penalties and interest at the end of the year after you file the return due to late payments.